October 2023. Japan sells $63 billion in US Treasuries in 1 month, the largest single-month dump on record. China follows with $40 billion, then the UK, then Saudi Arabia, then Belgium. The safest, most stable market in human history, $26 trillion, the foundation of global finance, is entering stage 3. And almost nobody's talking about it, because if people understood what's happening, if they realized the Treasury market is following the exact same 4-stage pattern as every asset bubble in history, there would be panic. Not eventually. Right now. By the end of this video, I'm going to prove to you, using data from the Federal Reserve's own reports, that we're watching the largest, most systemically important market on Earth begin to break. And when it fully breaks, when stage 4 hits, everything else goes with it. Your savings, your pension, your purchasing power, everything. This isn't prediction. This is pattern recognition. And the pattern is screaming. Let me give you the pattern. Stage 1, establishment and trust. An asset becomes the bedrock of the financial system. Decades of stability. Governments, banks, pension funds, everyone holds it. Risk-free, trusted, boring. US Treasuries from 1945 to 2008, the safest asset on Earth. Backed by the largest economy, the reserve currency, the full faith and credit of the United States government. For 60 years, Treasuries were boring in the best way. Predictable yields, liquid markets, zero defaults. Every financial model assumed Treasuries were risk-free. Every portfolio held them as the safe anchor. Total trust, total complacency. Stage 2, manipulation and financialization. Someone realizes they can manufacture unlimited supply through policy. The Federal Reserve discovers quantitative easing. 2008 to 2021, they create dollars from nothing and buy treasuries, not millions, trillions. The Fed's balance sheet explodes from $800 billion to $9 trillion. They're not just a buyer, they're the buyer. They create artificial demand, suppress yields, and flood the system with paper claims on future tax revenue that doesn't exist. For every dollar of real economic value, there are now $10, $20, $50 of debt claims. Paper multiplies far beyond anything the underlying economy can support, and everyone pretends this is normal. Stage 3, the squeeze. Reality intrudes. Inflation forces rate hikes. The Fed stops buying and starts selling. Suddenly, there's no bid. Foreign holders who accumulated trillions during the cheap money era start dumping. They see the math. They know what's coming. Banks holding long-dated treasuries at low yields watch them collapse in value. Silicon Valley Bank, Signature Bank, First Republic, all killed by treasury losses. We are here right now. The largest holders are exiting. The primary buyer has left, and the cracks are spreading. Stage 4, the break. Liquidity vanishes. Yields spike violently. The market freezes. Trading halts. The government can't roll over debt. Either the Fed restarts QE, destroys the dollar through hyperinflation, or the Treasury market fails and takes the entire financial system with it. Now let me prove this pattern is real with the moment it almost happened before. September 2019, the repo market, the overnight lending market that keeps the financial system liquid, suddenly seizes. Rates spike from 2% to 10% intraday. Banks won't lend to each other. Panic. The Federal Reserve has to inject $75 billion overnight, then $100 billion the next day. Then they establish a permanent standing repo facility pumping hundreds of billions into the market every single night just to keep it functioning. What happened? The system ran out of high-quality collateral. Treasuries? The safest asset wasn't safe anymore. Banks couldn't get enough to post as collateral. The plumbing broke. And the Fed had to become the permanent backstop. That was stage 3, a warning shot. The system ignored it. Then March 2020, COVID hits. The Treasury market, the most liquid market on Earth, freezes. Bid-ask spreads blow out to levels never seen. The 10-year yield swings 60 basis points in days. Funds can't sell. Margin calls cascade. The Fed has to step in with $4 trillion in emergency purchases over 18 months. They didn't save Treasuries because they're prudent. They save them because if Treasuries fail, everything fails. Mortgages, corporate bonds, commercial paper. The entire debt structure of civilization is priced off Treasuries. If the foundation cracks, the building collapses. That was the preview. Now the main event is starting. Let's start with who's selling and why. Japan, the largest foreign holder of US debt. $1.1 trillion in 2022, down to $1.02 trillion by late 2024. They're selling. Why? The yen is collapsing. Japan's central bank is defending their currency. To buy yen, they have to sell dollars. To sell dollars, they dump treasuries. And it's accelerating. Every month, billions more. China, second largest holder, $870 billion in 2022, down to $770 billion by 2024. They're liquidating. Why? Geopolitical tension, sanctions risk. They watched the US freeze Russia's reserves overnight. $300 billion gone. China is diversifying out of dollar assets before the same happens to them. They're buying gold, stockpiling commodities, building alternative payment systems. The treasuries are going. Saudi Arabia, they held $120 billion, now under $110 billion. Oil producers who accumulated dollars for 50 years are reducing exposure. The petrodollar system is ending. They don't need as many dollars. They don't need as many treasuries. Belgium. This is the interesting one. Belgium is a tiny country with an economy smaller than Wisconsin. But they held $330 billion in treasuries at peak. Why? Because Belgium is where Euroclear is located, the clearinghouse for international dollar transactions. That $330 billion wasn't Belgium. It was foreign central banks parking reserves anonymously, and it's dropped to under $220 billion. Anonymous selling, massive, quiet, added up. Foreign official holders dumped over $600 billion in the last 24 months. The biggest sustained outflow since records began. These aren't retail investors panic selling. These are central banks, sovereign wealth funds, governments with perfect information. They see the math, they're exiting. Now let's talk about the buyer that disappeared, the Federal Reserve. From 2008 to 2021, the Fed bought $5 trillion in treasuries. Now they were the market. They set the price. They suppressed yields to zero, mortgages at 3%, corporate debt at 2%, free money for 13 years. Everyone levered up. Corporations borrowed billions for stock buybacks. Governments ran trillion-dollar deficits, assuming cheap debt forever. Pension funds, insurance companies, banks, everyone structured around the assumption rates would stay low. Then 2022, inflation hits 9%. The Fed panics. Rate hikes, 0% to 5.5% in 16 months, the fastest tightening cycle in 40 years. And they don't just stop buying treasuries, they start selling. Quantitative tightening. The balance sheet drops from $9 trillion to $7 trillion, $2 trillion of selling in 18 months. The biggest buyer just became a seller. Who replaces that bid? Nobody. There is no buyer of that size. The math doesn't work. U.S. government deficit in 2023, while $1.7 trillion. 2024 projection, $2 trillion. The government has to issue $2 trillion in new debt every year just to fund operations. Plus, another $7 trillion to roll over maturing debt. That's $9 trillion in annual issuance. Who buys it? Foreign buyers are selling. The Fed is selling. Domestic buyers, banks, pension funds, they're already saturated. They can't absorb more. So yields have to rise, not to 4%, not to 5%. Yields have to rise until someone is forced to buy, and rising yields mean falling prices. And falling prices mean losses, massive cascading losses. Silicon Valley Bank, March 2023, a $200 billion bank. Top 20 in America, dead in 48 hours. How? They bought long-dated treasuries at low yields. When rates rose, those bonds collapsed in value. Unrealized losses, $15 billion, marked to market, the bank was insolvent. Depositors figured it out. Bank run, failure. The safest asset killed them. Signature Bank, same week. $100 billion gone. Treasuries again, First Republic, May 2023, $230 billion. Treasuries. The FDIC had to seize it and sell it to JP Morgan at a massive loss. Taxpayers ate the bill. 3 top 20 banks dead in 10 weeks, all from treasury losses. The safe asset. Now ask yourself, if these banks failed with treasuries, how many others are sitting on unrealized losses right now? The FDIC's own data, U.S. banks are holding $620 billion in unrealized losses on securities as of Q3 2024. Most of that? Treasuries. $620 billion. Now that's not a rounding error. That's systemic. If depositors panic, if banks have to sell those bonds to meet withdrawals, those unrealized losses become real. Banks fail. FDIC steps in. But the FDIC Deposit Insurance Fund, $120 billion, enough to cover maybe 2 regional banks. Not 20, not 50. When the runs start, the fund is gone in days. Then what? The Fed has to print emergency liquidity, backstops, guarantees. Trillions of new dollars flooding the system to prevent collapse. And every dollar they print to save the banks destroys the currency. Inflation comes back, worse than before. The pattern repeats. Here's what makes this different from every other bubble in history. Treasuries aren't just another asset. They're the collateral for everything. Mortgages are priced as treasury yield plus spread. When treasuries fall, mortgage rates spike. Housing freezes. Corporate bonds are priced off treasuries. When yields rise, companies can't refinance. Defaults accelerate. Pensions are modeled assuming 3 to 4% treasury yields. At 6%, their liabilities explode. They're insolvent overnight. State and local governments, already deep in debt, refinance at higher rates. Services cut. Taxes raised. Recession. The reserve repo facility, Right now, there's $500 billion parked at the Fed in reverse repo. Money market funds and banks parking cash, overnight earning interest. That's $500 billion not buying treasuries. It's a liquidity drain. When that unwinds, when funds pull that cash, you need to put it somewhere. If treasuries are falling, where does it go? Gold, Bitcoin, foreign bonds, anything except dollar debt. And the selling accelerates, the yield curve. It's been inverted for over a year. The longest inversion since 1980. Every time the curve inverts this long, recession follows. And in recession, tax revenue collapses while spending explodes. Deficits balloon, more issuance, less demand. Yields rise further, debt spirals. This is stage 3. Recognition that the math doesn't work, that there aren't enough buyers, that the safe asset is radioactive and everyone's trying to exit quietly before the stampede starts. Stage 4 hasn't fully hit. But we're at the door. Here's what it looks like when it does. The trigger. A failed Treasury auction. The government tries to issue $50 billion in 10-year bonds. The auction fails. Not enough bids. Yields gap 50 basis points overnight. Panic. Or a major foreign holder dumps everything at once. China liquidates $500 billion in 2 weeks to defend the yuan or support their collapsing property market. Treasury prices crater, or a large bank fails. Bigger than First Republic. $500 billion. $1 trillion. The FDIC can't cover it. Depositors at other banks panic, runs spread, banks forced to liquidate treasuries to meet withdrawals. Selling begets selling, or geopolitical shock. Taiwan invasion. Middle East, war goes nuclear. Foreign holders liquidate dollar assets. Flight from treasuries accelerates. Any of these triggers, stage 4, the cascade, yields spike, not gradually, violently. The 10-year goes from 4.5% to 7% in a week. Mortgages hit 10%. The housing market freezes instantly. No one can buy. No one can sell. Corporate credit markets seize. Companies can't issue debt. Layoffs start. Recession becomes depression. Pension funds, already underfunded, collapse as their treasury holdings evaporate. Benefit cuts. Retirees devastated. States declare fiscal emergencies. Illinois, New Jersey, California. Pension systems broke. Municipal bonds default. Services collapse. The federal government faces a choice. Default on the debt, unthinkable. Ends dollar reserve status instantly. Or restart QE. Infinite money printing. The Fed buys everything. They become the only bid. Yields get suppressed temporarily. But the cost? Hyperinflation. The dollar loses 50%, 60%, 70% of purchasing power over 24 months. Your savings, your salary, your fixed income, all worth a fraction of what they were. Or the worst option. Treasury market freezes entirely. Trading halts. Liquidity vanishes. The government can't issue new debt. Spending stops. Social security checks delayed. Military payrolls missed. Government shuts down. Not for days, for months. And in that chaos, society breaks. Who wins in stage 4? People who saw this coming, who moved out of long-duration bonds years ago, who hold real assets, gold, silver, commodities, productive land, businesses with pricing power, assets that can't be inflated away. Countries with low debt, commodity exports, and fiscal discipline, they'll be fine. Switzerland, Norway, Singapore, Australia. Resource exporters, nations that didn't lever themselves into oblivion. Who loses? Bondholders, pensioners, fixed income retirees, savers in dollars. Middle-class Americans who did everything right. Saved responsibly, bought treasuries for safety. They'll watch 40 years of savings lose half its value in 18 months. Not because they made bad decisions, because the system broke, because the math never worked, because stage 4 is when lies meet reality. So here's what you need to understand. This isn't some abstract macro theory. This is about your life. First, recognize the risk. Treasuries are not risk-free. They're the opposite. They're the largest, most systemically leveraged asset bubble in history. The complacency around them is stage 1 thinking. Wake up. Second, understand duration risk. If you own long-dated bonds, 10-year, 20-year, 30-year treasuries, you're exposed. When yields rise, long bonds get destroyed. A 2% yield increase on a 30-year bond, you lose 35% of principal. That's not hypothetical. That happened in 2022. Many people still haven't recovered. If you're holding long bonds for safety, you're holding the wrong asset. Third, watch the Fed. If they restart QE, if they capitulate on inflation and go back to printing, the dollar collapse accelerates. Gold and hard assets explode. If they hold tight, let yields rise, more banks fail. Either way, pain. The question is, which flavor? Fourth, diversify out of pure dollar exposure. I'm not saying abandon dollars entirely, but 100% dollar-denominated assets, that's concentration risk. Gold, foreign assets, real estate, productive businesses, commodities, build resilience. Fifth, prepare for volatility. When stage 4 hits, it won't be smooth. Markets will whipsaw. News will be contradictory. Policy will flip daily. Have a plan. Know your risk tolerance. Don't panic sell at the bottom. Don't FOMO buy at the top. Discipline wins. The pattern is clear. Trust, manipulation, squeeze, break. We're in the squeeze. The largest foreign holders are dumping. The Fed is tightening. Banks are sitting on massive unrealized losses. The math doesn't work, and everyone's pretending it's fine. Until it's not. The Treasury market is 26 trillion, larger than the entire US stock market, larger than all global gold. It's the foundation of the financial system. When the foundation cracks, the building doesn't stand. It collapses. And the collapse won't be orderly. It'll be chaos. September 2019 was a warning. March 2020 was a warning. March 2023 was a warning. 3 warnings in 5 years. How many more do you need? The Treasury market is telling you the truth. Foreign central banks are telling you the truth. Failed banks are telling you the truth. You just have to listen. Every fiat currency in history has failed. Every bond market in history has eventually broken. The pattern repeats because the incentives never change. Governments always print. Central banks always inflate. Politicians always choose easy money over hard choices. And the people holding paper always learn the same lesson. Paper promises are worth exactly what they're printed on. Nothing. So here's my question. Are you going to wait until the Treasury market freezes? Until your bond fund is down 40%? Until your pension announces benefit cuts and wonder how you missed it? Or are you going to recognize the pattern, trust the data, and position yourself before stage 4 hits? The choice is yours. But the window won't stay open forever. If this made sense, if you see the pattern, subscribe now. Because what I've shown you is just one piece. The Treasury collapse connects to the currency crisis, the banking system, the pension crisis, the commercial real estate implosion, all following the same 4-stage pattern, all headed to the same inevitable conclusion. Subscribe, watch the next video, learn the full picture. Because people who see the pattern early don't just survive the collapse. They position themselves to thrive on the other side. The clock is ticking.